Moving on, we get on to the what is meant by the term property growth. I will pass you on to yourself, Paul, just shortly. Before we say that, though, we have had a lot of people asking about this. It's something that's a bit of a hot topic at the minute. And it's, well, you'll go into more detail, but it's a little thing that can confuse a lot of people, I think.
I think it can, and bear in mind there's going to be some figures on this screen that you probably won't be able to see, so we're going to have a downloadable PDF so you can read it in your own time.
All the slides are downloadable.
All the slides are downloadable, so have a look at that in your own time. But the idea of this slide is just to go over what are the factors that would indicate an area is about to grow in value. Is there a right time to get in and get out? What are the advantages of taking a punt on an area? What signs should I look for in a location? What are the key indicators in the market? For example, should I look at asking prices or going up or selling prices? How can I check if an area is oversaturated? How do I know an area has demand as a landlord? And what does the phrase, if you are hearing about it now, then it is probably too late mean? So we've got 4 slides and they're all of different aspects of growth. And we will run through a couple of examples and discuss it, and then we can go from there about what these show. And like I say, please download it, because once you look at it yourself you'll probably understand where we are with it. There's no right or wrongs in these, it's just there's right times when people should have bought and wrong times to buy, if that makes sense.
So
this slide basically is covering time to buy, to get in and get out, major infrastructure changes and a migration from the city centre, sorry about the typo, and theoretically there should be these, or it should be easy to sell, so why don't we? So these are all areas that according to property data, the average property, not specific property, the average property has gone up by more than 30% in the last 5 years, which on the face of it is a great thing, isn't it? That's what you want from a property. If you can buy and then 5 years later your property's gone up 30%, you can't ask for much more than that. And some of these areas have gone up as much as 70%, you know, brilliant. So we could easily jump on that bandwagon, for example, for Liverpool L1 and say, right, okay, 5 years ago, average asking price was 109,000, average asking price is now 154,000, 5 year growth has been, you know, 71%. That's fantastic, isn't it? Easy to sell in historical values. But that isn't what you do. You should have bought 5 years ago in Liverpool, not now, because the key indicator is the average sold price, which is what people are selling for, and the average property against the average asking price is £110,000, which means theoretically, if you look at these numbers, that as soon as you buy a property, an average property in Liverpool right now, in L1, you are losing 30% if you sold it tomorrow. That's what it's saying. Now, if you bought it 5 years ago, not an issue. You know, actually, to be fair, it actually evens out on this. That's fine, but that's why we don't go there, because we feel it's topped out, and that covers things like the northern quarter, where over the last 5 years it's made 30%, and we got into Manchester a little bit more on the next slide, but it went down 9% last year. So if we marketed a brochure saying 30% growth the last 5 years, that looks great, but what we're not telling you is that it's actually gone down 10% last year, and your asking price is 50 grand below, sorry, your selling price is 50 grand below what you're asking. And what happens in major city centres, you know, in some of these areas, like the south side, we sold in the Leeds south side, didn't we, where there's a massive regeneration, and all these areas on here are all about regeneration as well. Luton with the exception, because that's commuter, and like every commuter town in London, it had its time. You look at these regeneration areas, so 5 years ago the big influence in Leeds was the south side, you know, because that's where the money was going. And we sold there probably 4 years ago, weren't it? But you'll see on another slide now, the area in Leeds to focus on is something different, because that's done its job. It's gone up to an area where it can't go. It's, you know, it's still doing quite well, but at some point it's going to plateau and drop, because that's what happens in these areas. So with all these areas, if you bought there 5 years ago and you sold now, you're going to be doing all right. The difference is buying there now, apart from 1, maybe 2, I'd say, you're probably going to buy with nothing much in the pipeline, I would have thought, or nothing much on the equity front.
And quite a few of these areas are areas that I certainly see in my feeds and emails with people advertising property, saying amazing deal, etc., etc.
Yeah. Well, so like I say, the two that come up on mine are always Liverpool and Manchester. Nothing against them. We are 20 miles from each one. You know, we could do it all day long. If someone said to us, I really want somewhere in Liverpool, it's fine. What we're trying to say is, we're not saying there's anything wrong. They've grown exponentially. They've done very well. Manchester is following London in terms of regions, and how one moves from the other, to the detriment of the other. But what we're trying to do is, we're trying to find the places, and sometimes it's very hard, that are 5 years ago, not now. We want the properties we sell to show that with regeneration, and that's what we'll talk about, regeneration as a growth market, these are the places where we feel where it's plateau now. It actually doesn't look very attractive now, but we feel with the money going into it, it can only get better. And if we can offer those places where you buy now and in 5 years' time, we're getting a phone call saying, you're right, that's good. Now it's hard, and sometimes it feels like you're flogging a dead horse with it, you know, but those numbers are based on averages and they don't lie, they're based on facts. You know, they're based on average prices off a reliable source. Any thoughts?
Yeah, I mean, I still get more people, I probably speak to 30 people a day. I still get more people, I'll tell them what we do, and they'll kind of agree with me, but they'll say, but I still want to buy in Liverpool. And so there's actually more people still going against what we're trying to do and what we're trying to show, which is fair enough. And we were talking before about sometimes we think, well, what the hell, you know, we'll just start selling in Liverpool in L1 and we'll make more money. That's not what it's about for us. We want to make our clients money, and that's why we've got over 70% referral and repeat business. Because once people invest with us and they see what they can achieve in these high growth areas, because a lot of these high growth areas are also best for yields, because the price is at the right level for the rents that they're getting. So they're getting higher rents, both in long-term ASTs and in short-term lets as well.
Yeah, and I think that's the thing about, you know, I always see this, and it's a bit corny, but the fun people who got to the party on these areas got there 5 years ago. The people who are coming to this party now are watching all the fun people leave and go somewhere else. But they don't know where they're going. They've just come to the party late. And it's not a criticism, because, in fairness, you are inundated with these properties. Just because you see 4 different properties in a certain area being marketed doesn't mean them properties are needed. You know, you can easily do your work and find out, right, okay, let's go on Rightmove, find out properties are for rent. Does it really need another 2,000 apartments coming on?
Right.
Where are these people coming from?
You have also to remember that when you see areas such as inner city Manchester and things like that, and you see lots of them in your emails, then naively, or what a lot of people won't know is that there's overseas investors, and we've been to China, and I've walked into a room full of investors with an investment in somewhere like maybe Preston at the time or wherever it was, and all you got all day long for a week was, have you got anything in Manchester? And because they're overseas, they don't know England, they've heard of Manchester, and for them they're just fixated on that. But that will have an impact as well on people selling in those areas.
And it's industry led, and that's where we're trying to be different, which is the thing. And it's like, I bought an air fryer, and I bought a Ninja. You know why? That's all I ever hear about.
Yeah.
Ninja.
Oh right, sorry, a Ninja air fryer.
I
didn't mean a Ninja and an air fryer.
Hard to pick up nowadays then, to be fair. A couple of samurais in the cupboard, but no. But I bought it because that's all I heard about.
Yeah.
Does that mean it's the best on the market? I have no idea.
Well,
does it mean it's the most expensive? Yes. And that's the same with property, weirdly enough. And what we're trying to do is just protect, and like I say, we're not going to, all we can do, and we've had plenty of calls like this, is say what we feel about property. Might be wrong, might be right. Liverpool might go up another 70% next 5 years. No, by the way. And we could be wrong, but we're not willing to take that point. We'd rather get you to, it's not about, we want you to sort of believe in what's coming forward, because you know, if you live in an area like this, you know, you look at London, you look at some of these areas, you know, both worked in London, all worked in London, and you've seen areas that really have nothing to offer become gentrified. And I'll give you an example. It was someone that one of our consultants was dealing with, and I often get asked on, why did you bring a property on, or why did you bring an area on? And this gentleman, and nothing wrong with it, went to view and went to a load of local estate agents, and this property is a refurbishment property in Cheltenham. And And the estate agent went and sort of said, right, okay, well, it's been sold at £400 per square foot. Other properties like that in and around Cheltenham are about £600 per square foot. And he said, but the problem is the street brings it down a little. It's a little street, it's probably got 30 houses, if that on, but 3 or 4 are in a little bit of disrepair. Yeah, so that's why you're getting at £400 per square foot. And that's why I'm bringing it on. Because in normal works, and people will testify to this, once the street starts going up market or become gentrified, the rest follow. And the idea is then that once the rest follow, the estate agent's already told you that your property should be £600 per square foot in the city centre of Cheltenham. You bought it for 400. By my maths, that's 50% you've made on a property. But over time, and I think we mentioned earlier when we were talking, we are dealing sometimes with, whether they're right or wrong, people who will tell you there's an instant gratification in property. Property investment is about patience. You know, there are some good quick hits that you can get buying in the right time at the right place.
Yeah.
But with that, if that street in 5 years has become great and as everything else, beautiful Georgian building, then that guy's got a good investment, you know, at the end of the day. So that's why we bring it on, because we see the potential. If you want to, the £600 square, go to the estate agent. I don't see anything, just see the organic growth. Yeah. So that's where we are with the markets like that, and that's what we try and do.
Fantastic.
Yeah.
Right, moving on.
Rant over. So these are 2 cities in particular that it's about what happens with the migration of development and people. So Manchester in 2012 really started seeing the big impetus, and in Salford the BBC came in 2012 and property prices really grow. Now these are only 5-year charts, but the fact is the average price of a property in Salford in 2012 was £110,000. The average asking price of one now is £245,000. The average sold price is £237,000, but the last 5 years it's only had a 9% growth. Now that means that you should have gone into Salford 10 years ago again, or 9 years ago, when there was nothing there, because regeneration areas can only happen when there's nothing there, when it's industrial. And then the next one came along, which then took over from Salford, which was M4, the Northern Quarter, that sort of thing, and over the last 5 years that's had a 30% increase. But again, like Salford, it's gone down by 9% this year, because the next area came along, and this is like London, you know, in all the areas, they move from one to the other. And Miles Platting, which is part of the Northern Gateway, a big area, has gone up 69% in the last 5 years, and it's still rising, you know. But again, you're always in that market, and you're going to run out at some stage, and now you are sort of seeing, I mean, I think you were amazed at the fact that you can buy in the Northern Quarter for less than Salford.
It's amazing, because you, with the Northern Quarter, you can walk into Piccadilly Gardens in about 2-3 minutes. At Salford, you have to take a tram or a taxi.
Yeah.
You know.
And each of these, you know, 3 areas, the sold price is less than the asking price now. You know, if you bought in Miles Platting theoretically 5 years ago, you made 166% profit, which is brilliant. You know, 16% in Northern Quarter and 5% in Salford, which shows that as one emerges, the other one falls behind a little bit, because people get their attention caught by something else. But I think this is the more interesting one, and this is Leeds. So Leeds has always been the Manchester on the east side, you know, of Yorkshire. And Leeds City Centre is the place to be, a little buzzing place, all this sort of thing. And then
it's a lovely place.
It's a beautiful place. Yeah. And the south side came along. Now the south side was places like Hunslet, you know, all that sort of thing, where pretty downcast. But because you can't really do much in Leeds City Centre, they needed somewhere like the inner cities of London and Manchester, needed somewhere to expand to that was an industrial area, and that has grown, you know, 5 years. LS1 has grown 2% in the last 5 years. LS10, Hunslet, has gone by 34%. Now Leeds has pretty much flatlined LS1, and you know, Hunslet is still going up. But what I find interesting is now that it's more affordable to buy in Leeds City Centre than it is on the south side. And me, as someone who brings on the properties, would now be very interested in looking at properties in Leeds, because at Leeds City Centre should always be more than one of its suburbs. So I think that's an area that is going to grow, and I think potentially the south side will plateau. But for the people we sold on the south side, they've done pretty well,
Yeah.
according to those numbers. But that doesn't mean we're just going to carry on back in that horse. We've got to sort of say, all right, these numbers now say actually, let's go to the city centre here. Let's back the other horse now. You know, so that's where they're really interested. So doesn't look positive on it, but I think it's got massive potential that that's somewhere we're going to be targeting because it backs up against everything else.
We do, just going on a tangent, we do have a question in that states, is being fixated on a specific area detrimental to growth as an investor? I think unfortunately we don't know, I haven't got who that question is from, but thank you very much for the question. I think what that's aimed at really, or how I'm reading into that is, and the short answer from my point of view is yes, it is to an extent. I understand there was maybe an old school group of people that like to manage their own properties within a 10-mile radius of them, and if you have the ability to do that, then fine, and it's all very secure and safe, you know it. But are you honestly getting the best for your money and for your own goals? Because there's other areas in the country, as we're showing, that if you go out of your comfort zone and go, okay, maybe I will put my faith in X management agent over 100 miles away, then I can get the return.
The world is intertwined now. I get you out of your comfort zone, aren't you, because you don't know the area. So you've got to believe people like ourselves who tell you about the area. I understand people wanting to buy the area, but does it mean it's the best investment? No, not at all. You know, it could be, depends where you live. You could end up living in a hotspot somewhere. But no, it's just trusting on the numbers and asking someone to explain, okay, why are you telling me this? Because it doesn't matter about you managing it. You know, unless you're managing it full time anyway in your local area, you're going to get a third party to do it. You can get a third party here, Chester, Aberdeen, wherever you want. Doesn't matter. But if I sort of said to you, right, okay, I'm going to buy a Range Rover, don't know how much they cost now, you know, and it's 60 grand next door to you, but you can buy one 200 miles away for 40, you're going to buy the 40 one, aren't you? You know, and that's no different in terms of how it works.
Yeah.
What we're sort of saying is that area could work for you, but if your property is worth, well, let's say if your property is worth 300 grand and next door's going for 200, buy it.
Yeah.
Because you know yours is worth 300 grand, buy it. But if it's going for 300 grand, why would you buy it? You know, whereas if you found out an area that you may know or may not know, do it. And I think being fixated, it depends on the area. If you get fixated by believing what people are telling you to buy all the time, you know, through the likes of, you know, the big machines that go through, the massive companies much bigger than us, if you get fixated by them telling you, ask them to justify it. You know, ask them to say, how do you know it's going to grow this much when basically it's gone down this much in a year? You know, it's about listening to the facts and not just buying, and I hate the phrase, but it can be a sheep culture.
Yeah.
People feel comfort in knowing people must be buying there, but it doesn't mean it's the right place to buy.
Well, you said it yourself, John, that you said that you speak to clients on a daily basis, they love the information you provide them, they agree with you, and then they say, what have you got in Liverpool?
Yeah,
or they'll say whatever. What have you got round near me?
But as well, I mean, there's still good areas of Liverpool to invest in, and it's not just the area. I mean, in every city out there in the UK, there's good areas and bad areas to invest in. I mean, we're particularly drawn to areas where we have a presence for corporate lets. That's really what drives us, because we know we've got a rental market, a ready-made rental market for our clients, which is really important, because everywhere there's hundreds of apartments being thrown up in major cities. Those developers don't care whether they're rented or not.
No.
They're just selling them, and the reason why they're selling in the major cities is because generally people don't understand growth, but they can sell previous growth on that property. Like you were saying before, Paul, you're saying, right, this place has grown 40% in the last 3 years, brilliant. What's the likelihood of it growing another 40% over the next 3 years? Probably zero, you know?
I think the strange thing with respect as well, when you find there's a lot of London investors, because obviously, you know, if you've had a property in London 15 years, you're sat on money at the end of the day.
Yeah.
It might be easy to think that every place is like London. It's not. Everything's got a limit. You know, there is not going to be another London. And like I say, there's always a good place to invest. And would I not sell something in Liverpool? No, because if someone says, again, it's like that, if it's an odd property and someone's saying, right, I need 100 grand for this and I want out, and next door is worth 150, yeah, I'm going to sell it.
Yeah.
Because it's about the investment itself, and I can show you what that investment is about.
Yeah.
And I'm saying to you, because that's the other bit that people forget about growth. Growth doesn't have to come like this. Growth can be built into a price if someone's looking to sell below market value.
BMV, below market value.
If we had something now in Tithe Barn or Dale Street in central Liverpool, we'd be all over it.
Yeah.
If the price was right, because we know we're getting over £200 a night.
Yeah. And we work very close with our developers. We work with our developers for the pricing and what we do, and certainly some of the secondary and tertiary locations, because some of the really, really big developers who will go out to multi-agents will just look, oh God, we sold that one out quite quickly. Let's put 20 grand on these next ones and just see where we are. And they're like, if people carry on buying, that's inflated growth. That's not real growth. That's just people buying over the price, which looks good. But like I see, when it's some of these, when it comes to selling it, you find out people aren't willing to pay it. You know, so that sounds negative, but in the end of the day, it's positive if you found the right place.
Yeah.
We move on, Maestro.
We can do.
So these four are areas, and obviously there's hundreds of areas across the country. You know, I've picked some areas where we've focused on particularly, etc. These are areas now where you can buy the average property and actually sell the average property for more. And they're interesting because they're split into two. One is Aberdeen, which we'll come on to later, which is an area we focus on, which doesn't look pretty on the face of it. Leeds City Centre, which we've talked about. Luton, where we sold about 6 years ago. And Digbeth, where we sold about 4 years ago. Now, Aberdeen and Leeds, you look at the 1, 3 and 5 year growth figures, there's nothing exciting about that, but we've already explained why Leeds could be appealing, because it's now more affordable than other areas around it. Luton, a commuter town, easy, you know, and it was relatively cheap commuter town, but again, it's plateauing now. It went down by 4% last year, but over the 5 years it's gone up 47%, so that would say to me, okay, your time to buy there is probably gone if you're looking to invest. And the same with Digbeth, because there's more properties coming on the market in Digbeth, so the saturation's become a little bit there. I think our development was the first one actively marketed in Digbeth properly. Apart from a few of the other big developers, I can't remember the name.
Yeah, Smithfield. There was a couple in Smithfield regen, wasn't there?
And you know, and that's in around about 30%, and that's starting to go. So those two areas are where we would like to say, right, okay, perhaps the time's gone. Perhaps there's another area in Birmingham now that's on the up, etc. Perhaps there's another satellite town around London, but they've been pretty much done now, you know, because there is always a demand for it. So those are areas where you are still in the game with it if you sell. And when we're saying about buying and selling now, you know, they're never going to go plummet, but it's about they're going to plateau. So anyone who's bought 5-10 years ago, if they carry on and they pay the price, their yields are going to be twice as good as anybody else buying now as well, because you forget about that bit. If someone's bought 50% below what it is now and they've not refinanced, etc., their yields are far higher than what someone's going to get buying now, because that's important. So there's not much more on that at the end of the day, and the next slide which we're going to go through is just going to be the areas where we see interest based on what we've said about the things like regeneration, money being ploughed into the place, people migrating to it, people in universities stopping in the areas, which is a big thing, and not going somewhere else. But on the face of it, they won't look very interesting on the numbers, but I think that's what is interesting, you know, because they are going to do quite well with the key indicators we've seen from the other areas that have made money over the time.
One of the biggest key indicators there is commerce, isn't it?
Yeah.
You know, when you get commerce, regeneration, transport links, HS2, for example. You know, we've got more questions.
We have got another question, which possibly might lead on to the next slide, and it's slightly putting us on the spot here, so we'll see how we do. Deb Shapiro again, thank you very much, Deb, for your question. Please, each of us choose a best investment area for 2023 with details, e.g. short-term lets. If you had a spare £200,000 free, could be put on the spot a little bit, but I mean, is it worthwhile going on to the next slide to discuss that at the same time?
I would say so.
Okay, let's do it.
So these are 4 areas where I'm particularly interested. There's more as well, but these are 4 areas I'm interested in. One, we're already marketing, which...
You're taking 4, are you?
Of those, I mean, right now, so when it comes to short-term lets, it's different, because if you're just saying, right, okay, who shall I go out to and look at estate agents' windows and see, doesn't work. On a short-term let, it needs to be sold as a brand, so it needs to be a multi-unit development, you know, so at the end of the day, that works well. Having a one-off...
You can't just go one-off and just go... Well, you
can,
yes,
but it's going to cost you a fortune
yeah.
to find cleaners, all this sort of thing. It's, you know, it's economies of scale, it doesn't work that way.
You've got to find your demand. What's your demand? Everything. It's not just that, oh, I'll buy there and do
Well,
it.
and from our side, we've got to find developers who are willing to play the game and price accordingly as well, because you've got to realise developers are pretty intelligent people half the time. They know this hype is coming, they know what they're doing, because when we talk about Aberdeen, the amount of money that's been invested there, you've got to realise, with all due respect to people, 200 grand, 150 grand is a lot of money. These people are ploughing tens of millions into it, you know, so they don't do that on a whim at all. But these are the areas where we know there's some good regeneration, or there's other values. So Aberdeen, which Mike will talk about in a minute because he's on the front line with it. Wrexham is very interesting. Wrexham actually doesn't, for what we've said, doesn't stack up at all. But you've got major gigs coming to it. You've got the American takeover of Wrexham. You've got the 2nd largest industrial estate in Europe, I believe, which was the first up until they took over today, I believe it was, wasn't it?
Yeah,
by
Trafford
Park, yeah,
Trafford
overtook it today. You've got a massive amount of money, it's got higher employment figures and everything, and that all leads to a growth. With Leeds City Centre, the main interest in that is because it's the place to be in Leeds, and I think it is now overlooked. Derby, because I just think it's a good bet, a consistent. I think it's similar to Chester in a way as well. Never going to drop, it's never going to boom, but it's going to do quite well, and it's very central.
Derby, my pick on this, and I'm not just saying that because it's in there, would be Derby, because I'm a Derby lad and I know the potential in there.
Yeah.
It's a bit of a rundown place, so it has always. It's never shone. It's never been Birmingham or Manchester.
No.
But there's a huge amount of potential. We've got you remember the development that was going on last year?
House,
right in the centre. You've got the upgraded shopping centre that's just over the road from it. There's a lot of stuff going on there that Derby's always tried to boost itself, and it's still trying now. And I think it's still got that potential. There's there's a huge amount of massive companies around it. You've got JCB and places, people like that.
Yeah. No, it is. It is.
There's a lot of potential with Derby.
And you've got Aberdeen now.
I love Aberdeen. Sorry, just to pile in it. No, I just.
Mind.
I know, no. But just, Derby's my pick. But I love Aberdeen from the point of view that if you search now, if you were just going being a bit, I don't know, naive, and went, all right then, I'll look up Aberdeen. And you look up Aberdeen house prices, it'll be at the bottom of every table, and people will go, hang on a minute, in the past 10 years or whatever, it's actually gone down in value. So what are you talking about, Paul?
Well, it's actually levelling out. I mean, it was 10 to 5 years it took a plummet because everything hit it that shouldn't, you know, the oil industry went, etc. But people forget it's the 3rd largest city in Scotland.
Yeah.
I'll let you, Mike, say about what's coming into the place. You've got Shell back in there, haven't you, all this sort of thing.
Yeah.
You are still looking at sold prices still higher than asking prices, which shows a strong market. And this is where figures can sometimes not be reflective of what it is, because this can't go down any further. There's only one place it can go, but it is going to be a 3, 4, 5 year plan. Now on the short-term let side, or any rental side, the lower you buy, the better your returns are going to be. Because that is not, short-term let is not reflective of the property price. You know, and that, so going back to sort of Liverpool, 70% growth, your nightly rate is probably the same as it was 5 years ago as it is now. But your yield is massively lower because it's all related to the two. So the lower you can buy with a strong corporate market, the better you're going to be. Yeah. You know, and all these areas would say that, you know, if you could buy something in Wrexham for whatever, 100 grand, you're going to get a decent nightly rate on that. And you're going to get a pretty good occupancy. So this is what we're trying to find. But if you want to go a bit more into Aberdeen, Mike, because like I say, you're on the front line with it all.
Yeah, well, I wouldn't have picked Aberdeen initially when we first took it on, we normally do about 3 months of work on areas, don't we, before we even think about releasing anything. And Mike Holliday, our investments manager, came to me and said, you know, what do you think of Aberdeen? And I said, well, the only thing I really know is that, but pre-COVID, there was a huge competition with oil prices with the Middle East and the UK. And the Aberdeen oil rigs lost a lot of business. So when COVID came along and hit the oil rigs quite hard, it was an easy decision for them to close a lot of them down because they weren't competitive. Look at where we're at now. The UK government want as many domestically grown energy sources as possible. They don't want to be buying off Russia and the Middle East anymore. They want to grow it domestically, and they also want to be doing a lot more eco fuel. So the ETZ initiative, which has been launched over the last few years in Aberdeen, is bringing £12 billion worth of investment to the city. You visit there and people are generally buoyant about what's happening to the city. Per capita, it was one of the richest cities in Scotland, in the UK, let alone Scotland. There was a real affluence about the place, and that is going to return.
Well, saying that, you base it on all that with COVID, which is what, 3 years ago now. So for that to have remained actually pretty static when everything left it is pretty strong. Because if you took Media City out of Salford, it wouldn't remain static.
No.
It'd lose all its appeal.
Yeah.
So the fact that house prices, they haven't grown, but they've only minutely dropped, is actually a very strong statement.
Yeah.
It's quite a strong market because its biggest industry basically came to a halt.
Yeah.
And now it's coming back. So what would logic say? You know, when you bounce a ball, what happens to it? It bounces back up.
Aberdeen's probably one of the only locations where I'd say, wherever you're bought at the moment in Aberdeen, you do well. And I don't like saying that because I like to sort of target our developments, because our developments, we normally go one step further. For example, in the centre of Aberdeen, there's a huge commercial building called Union Plaza, where Deloitte are stationed, as well as some Scottish energy companies. That's a 5-minute walk away from City Point, where we're selling. Shell, which have been a very, very good customer of ours for short-term lets, all over the place because they send people all over the UK, Shell Energy, that's a 2-minute walk away, their headquarters, 1,000 staff. So for us on the short-term let side, as well as the growth elements, as well as the fact that you're buying below market value, it just ticks every box. And I mean, to answer the question that Debbie posted, where would I buy? Mine's more of a concept. You buy in an area where the sales price is low compared to the nightly rate you can achieve for short-term lets. And also somewhere where we're confident of getting a high occupancy. Wherever we've done that, Preston, Bolton, Halifax, Birmingham, Luton, Cheltenham, Southampton, all over the country, we've got success stories, you know, and we've got case studies for all of them that we can show people. So, you know, that level of success, following our success there, is a no-brainer of an investment.
Yeah, I mean, it's a different topic, and you know, blatant plug for Aberdeen. It's good that John's in as well. But it is. I think the idea is that I think people assume the short-term lets. There's a lot of still misunderstanding that the more they pay for a property, the more they're going to get on an either way. It doesn't work that way.
No.
You know, you could buy something. You know, we've got stuff in Wakefield now and Doncaster where you're not paying a lot of money for it, and you're going to get decent returns. But like I say, it's not a plug about what we're selling. But I just want to go back. So, you know, we're 12 miles from Wrexham, and it's my job to go over and have a look. And because you feel it's a place of interest, that doesn't mean If I go in with an idea of what stuff should be selling at, but a developer is thinking, well, I know that I can charge more now because of all this, we won't sell it. If they're pricing it with everything factored into it, we won't sell it. Because the whole idea is you're the one that needs to benefit from the growth, not the developer.
Yeah.
You know, so that's the difference. It's like we have plenty of times when we work developer and say, right, okay, we'd like the lease to allow short-term lets. All right, how much are you going to put on the price for that? Nothing, because it's not your benefit.
Yeah.
The asset is always the most important part. And the other thing I'd say to Debbie about the question is, look out for some of the one-off sales that come through in areas that we already know, because that's where you'll get some growth as well. It can be for nothing. You don't have to wait then.
Yeah.
You know, you just wait 12 months and then just refinance and get the full benefit. So I think everything we do, we put a lot of thought behind, and yes, it might look sometimes it's just like we're picking up scraps, but we're not refusing a lot of properties because we don't think that in the long run, and we might not always be right, in the long run that you're not going to do very well out of it because it's just all singing, all dancing, glitter and gold.
Can I just pick up a point on that? And just on this, you know, people are, in a way, I suppose, plugging our services and what you do and what Mike does, Mike Holiday, behind the scenes in terms of sourcing. You said it earlier that we get offered, and I've seen, you know, I get offered stuff on a daily, weekly basis. We could probably bring on at least one development a day, if not two,
if
three
we wanted
developments
to,
a day,
bring on
if
one
we
every
wanted
day,
to.
Yeah.
The point is that a huge amount of due diligence goes into, it doesn't matter if it's a development of 500 units or one property. You, as a company, we don't take on and actually market a property unless we are convinced that this is a good property in terms of investment for our clients and to sell it on, because ultimately we're hoping, and we might get the business as well, repeat business in terms of investment, we might even get the management of it. So what's the point in going to a load of effort or just taking on anything, going selling it and then suddenly finding we can't?
Well, the point is, what I would say a lot of agents do is, you know, when it's like the multi-agency thing, we will take on the odd development where someone else is selling it as well because we think it's too good not to. But most you will see different people marketing the same property. That isn't a good thing because it means they can't sell it, you know. And if you're seeing something come up month after month after month, that's not a good thing, you know, because it should stand. So, you know, we've got to look at everything. As a company, we have to look at what the mortgage facilities are. We know what it's like, and we know a lot of off-plan properties now that are multi-stories high, that have things like that, are going to struggle down the line with it. So we take on smaller developments where there's not so many problems that can go wrong. We take on these areas where a surveyor's not just going thinking, what, another one? You know, all this sort of thing. But I think the most important thing that we do, in difference to most other agencies, is that we can be that person that you buy from at the start and we're selling at the end and managing in between, you know. So we go into business with people, and you know, we're not as big as a lot of them, but what we do is offer a service that where we back ourselves on what we're selling, and we will be able to prove the quality of what we're selling, the numbers. And to quote an old phrase, you know, you can lead a horse to water, you can't make them drink it. If someone doesn't believe it, that's absolutely fine, and they can make their own choices. We're not going to force anything, but we've been proven right a few times by a lot of the areas on these slides, like I said, that you can download, that we've sold in what we feel is at the right time, and then these things just carry on selling there because we're not going to market. No, that time has stopped. It's now time to find the next place.
Yeah.
And also bear in mind as well that sometimes you'll find us selling a development that another agent's selling, but we've negotiated on our sales that short-term lets is written into the lease, but the other company haven't got that. Now, the popularity of whether you like short-term lets or not, or you want to use it, with the popularity of short-term lets, having that in your armoury when you come to sell down the line could be huge. It could add tens of thousands of pounds to the value of your property.
100%. And we don't want people to think that we rely on it. It's just the fact for you have two options.
Yeah.
You don't have to do
It's
it.
the flexibility.
It's the flexibility of what you've got.
Yeah.
You know, it's better to have two options than one option. You know, and you don't have to do either. It's the asset itself is always the most important thing. The value for money for the asset, the growth in the asset, because that's what we can only sell, like I said, equity and yield. The good thing is short-term lets gives us equity and yield.
Yeah.
Usually it's one or the other. You know, so if you're buying a a 50 grand terrace property, it's going to be yield. You're not going to get any equity. If you're buying a higher price with something, then it might be growth in one of these areas with a little bit of yield. There's got to be a compromise somewhere.
Yeah.
But what short-term lets gives you, it gives you that little barrier where you can actually get on a level playing field for both of them.
Yeah.
And if it works for corporate lets, i.e. city centre in a city, it's probably more likely going to work for long-term lets as well. So you've got multi-stream investment options. So yes.
Provided it's the right type of apartment, which it is in most cases, we don't really sell purpose-built short-term let apartments. There have been a few exceptions where the area has just been too good that we've had to dive into it, or the deal's been too good. But generally speaking, getting a property which is you could live in yourself, you could sell to a family, you can sell to somebody renting on long-term or short-term. You've got multiple exits there, which is really important, and multiple markets to rent out into as well.
And I think the thing I like, coming back to the due diligence, etc. What I like about, or what we can offer with our developments, is if any investor wants to see the work involved in taking that on, we can show them. We can show them stats and figures like that. We're not just going to go, oh, developer X rag us up, and when can you sell this? And we've sold it.
Well, I do a little, when I'm looking at particular areas, I'm looking at an area now, and so I will go out to competitors who I hope not watching and do a little bit digging about what they're selling, and we sometimes shoot ourselves in the foot a little bit by being too honest. So when you act something a short-term let, you're responsible for all payments, you're responsible for bills, you're responsible for cleans, you're responsible for this. I've had something today that's selling on short-term lets that they don't understand, and they say the only thing that the net figure they're giving you is after booking fees and management. Well, they're missing out half of it.
Yeah.
And we'll tell you that half. So in your eyes, the figures will look worse for us, but they're the real figures, and they're just designed to look appealing. But when you dig into it, and I've always said to any of my clients that you send me, if you're looking at something and you send it me, I'll give you a nod, and if it's brilliant, I'll tell you to buy it.
Yeah.
Because that's more appealing. But if it's not, I will go into detail as to why it's not. And it won't be just because I want to sell it something, up, because I don't want to see someone lose 200 grand.
I mean, in our forecast, we even factor in council tax.
Yeah.
Which most of the time you can claim it back in full on your first one. So
the whole idea is when we do bring something on, we can justify everything we've marketed about it.
Yeah.